Hey, ever wondered what's really going on behind the scenes of your favorite companies? Beyond the flashy headlines and product launches, there's a whole world of numbers telling a deep, intricate story about their health and future. We're talking about financial reports.
Absolutely. And today, we're cutting through the jargon.
Yeah.
We want to give you a shortcut to truly understanding what those numbers mean, making complex financial concepts not just clear, but surprisingly fascinating.
Think of it as peeling back the curtain.
Exactly. On a company's financial soul.
That's right. Our mission in this deep dive is to demystify the core components of how companies report their financial health. We'll go from the big picture statements
Right.
to the nitty-gritty details so you can confidently grasp what's important.
We've got a stack of sources here.
We do.
It'll take us on a comprehensive journey through, well, balance sheets, income statements, comprehensive income,
How earnings per share are calculated.
and the fascinating world of stockholders' equity.
Yeah,
Get ready to have some aha moments.
definitely. By the end, you'll be looking at company news with entirely new eyes, I think. Okay, let's unpack this. When we talk about a full set of financial statements
Yeah.
under U.S. GAAP, what exactly are we looking at? Is it just one big report or like a package deal?
It's definitely a crucial package of documents designed to give a complete financial story.
Okay.
What's fascinating here is that these aren't just random reports, they're a standardized set.
Right.
Typically, that package includes the statement of financial position, which, we more commonly call the balance sheet.
The balance sheet.
Then the statement of earnings or the income statement.
Okay.
Then the statement of comprehensive income, the statement of cash flows, and finally, the statement of owner's equity.
Wow. Okay. So quite a few pieces.
Each one offers a unique lens into the company's financial health and activities, providing distinct but interconnected information about where the company stands financially, how it performed over a period, and how its ownership structure is evolving.
So if the company were a still photograph, which statement would that be? Which one gives that snapshot?
That would absolutely be the balance sheet. Or the statement of financial position, technically.
Right.
It's a snapshot, a picture taken at a specific moment in time, usually the last day of a quarter or a year.
Okay.
It tells you what a company owns its assets, what it owes its liabilities,
Right.
and what's left over for the owner's stockholders' equity at that precise date. It has to follow that fundamental accounting equation. Assets, liabilities, plus stockholders' equity.
Always balances.
Yeah.
I often hear about classified balance sheets.
Yeah.
What does that mean for someone like me trying to understand a company's health? Is that important?
Oh, that's a vital distinction. Absolutely. Companies can present a classified balance sheet,
Okay.
which means they separate assets and liabilities into current and non-current categories.
Oh, okay. Current and non-current.
And this classification is incredibly important because it immediately tells you about a company's short-term liquidity, its ability to meet immediate financial obligations.
Right. Can it pay its bills then?
Exactly. Versus its long-term solvency, which is its capacity to meet longer-term debts and continue operating into the future. A quick glance at these classifications can reveal if a company is, like, living paycheck to paycheck or if it has solid long-term foundations.
That's really helpful. So when we talk about current assets versus non-current assets, what exactly falls into those categories? What should we be looking for?
Okay, for current assets, think of resources expected to be converted to cash, sold, or consumed within 1 year or the company's operating cycle, whichever is longer.
So short-term stuff.
Short-term stuff, it's about immediate operational capacity. The big ones are readily available funds like cash and cash equivalents, obviously.
Right.
Then there are highly liquid investments intended for short-term trading called trading securities. These are recorded at their current fair value. We also look at accounts receivable, which is money owed to the company from customers, usually shown net of any allowance for amounts they don't expect to collect.
The bad debts. Yeah.
Exactly. And crucial for many businesses, inventory, the goods available for sale, and prepaid expenses like insurance or rent paid in advance that will be used up over time.
So things they have on hand for immediate needs.
Precisely. These tell you what a company has on hand for its immediate operational needs.
And what about the non-current side? What kind of assets are those, and what do they signal about the company's strategy, maybe?
Non-current assets, on the other hand, are the long-term resources, not expected to turn into cash within a year.
The bigger investments.
Yeah, these are the building blocks of the company's future, really. This category includes longer-term investments, which could be available for sale securities or held-to-maturity securities, or even investments in other companies. Then you have property, plant and equipment, or PP&E, the tangible assets like land, buildings, machinery, used in operations for more than one period, reported net of their accumulated depreciation, of course.
Right, the wear and tear.
That's where you literally see the physical infrastructure of a company.
Mhm.
We also have intangible assets like goodwill from acquisitions, patents, trademarks, shown net of amortization.
These you can't touch.
Exactly. And finally, other assets, which can include things like long-term pension benefit assets or deferred income tax assets, sort of a catch-all sometimes.
Gotcha.
Understanding this structure allows you to quickly assess a company's total resources and obligations, gives you insight into its financial stability and how well it manages its debt over the long haul. It's truly a holistic financial picture at a single moment.
That makes sense for assets.
Right.
What about the flip side? The liabilities, or what the company owes?
Yeah.
Same split, current and non-current.
Exactly the same split. Liabilities represent a company's obligations to external parties. Just like assets, they're classified as current or long-term. Current liabilities are those due within 1 year or the operating cycle.
The bill's coming up soon.
You got it. Think of the current portion of long-term debt. That's the slice of a larger loan that needs to be paid within the next 12 months. Then you have accounts payable money owed to suppliers, notes payable short-term loans, and accrued expenses like interest payable and salaries payable.
Things they owe but haven't paid cash for yet.
Right. And finally, unearned revenue. That's cash received for goods or services yet to be delivered. It's a liability because the company owes that service or product.
Ah, okay, because they owe something back.
Exactly. These show a company's immediate financial obligations, a key indicator of its short-term cash flow health.
And long-term liabilities, what are the big ones there?
Long-term liabilities are obligations due beyond 1 year. Common examples include bonds payable, those are long-term debt instruments.
Right.
Deferred income tax liabilities, which arise from temporary differences between financial accounting and tax accounting. Essentially future tax payments?
That sounds complicated.
It can be, yeah. And pension and other post-retirement benefit liabilities, which represent the company's future payment obligations to employees after they retire.
Big numbers sometimes.
They can be huge. Looking at these, you get a clear view of the company's capital structure,
Yeah.
how much of its operations are financed by debt, and crucially, how much of that debt is coming due soon versus further down the road.
So if the balance sheet is that still photograph showing what a company owns and owes at a specific point, then the income statement sounds like the movie,
That's a great analogy.
showing how a company performed over a period, usually a quarter or a year. So what's the plot of this movie and what should we be looking for?
This raises an important question. What's the purpose of this statement? Its core purpose is to provide information about how a company uses its funds to generate income, which we see as expenses,
Right.
and where it gets its funds, which are revenues.
Okay.
It also covers other sources or uses of funds not directly tied to core operations, which we call gains and losses.
Got it.
It's incredibly useful for gauging profitability, assessing investment value, determining creditworthiness, and even predicting future cash flows based on past performance. The plot here is the story of how the company made money, what it spent to do so, and what it had left over. The bottom line.
We hear cost all the time, but in accounting there's a distinction. Cost versus unexpired costs. What's the difference and why does it matter for the income statement?
Right, that's a fundamental concept. A cost is simply an amount expended for items like capital assets, services, or merchandise, the amount actually paid for something.
Okay, straightforward.
But unexpired costs are fascinating because they represent costs that haven't been used up yet. So they're treated as assets.
They still have value.
Exactly. They represent future economic benefits. These will expire in future periods and then be charged or allocated against the revenues from those future periods. Think of inventory.
Wait, this stuff on the shelves.
It's an unexpired cost and an asset until it's sold. At that point, it becomes cost of goods sold, an expense, because it's now used up in generating revenue.
Okay, it moves from the balance sheet to the income statement.
Precisely. Or prepaid insurance. An unexpired cost sits as an asset until the insurance period passes, and it transforms into insurance expense.
Makes sense.
Similarly, The net book value of fixed assets is an unexpired cost that gradually becomes depreciation expense over time. This concept is fundamental to accrual accounting.
Matching costs to revenues.
Exactly. Ensuring expenses are matched to the revenues they help generate, giving a more accurate picture of a period's true profitability.
And then there's gross versus net reporting on the income statement. Companies report revenues and expenses as gross, but gains and losses as net. What's the thinking behind that?
This is where the ordinary course of business comes into play. It's a crucial distinction for understanding a company's core operations. Revenues and expenses are reported at their gross amounts because they reflect the core ongoing activities that a company exists to do. Revenues are the total amount the entity expects to receive for goods or services transferred in its primary business.
The main operations.
Right. Expenses are the costs that benefit only the current period, or the systematic allocation of assets used up to generate revenue. These are directly related to the company's main line of work.
So the day-to-day stuff.
Exactly. Gains and losses, however, are different. A gain is the recognition of an asset not in the ordinary course of business.
Yeah.
Like a gain from selling an old piece of equipment, maybe.
Okay.
Or from an unexpected event, like finding something valuable on company property. A loss is a cost expiration not in the ordinary course of business, like a loss on the sale of investment assets, or from something unexpected like an abandonment or a natural disaster.
One-off events, sort of.
Often, yes. They're reported at their net amounts because they're often from peripheral or incidental transactions. They're not part of the primary, repeatable revenue-generating activities. So the income statement clearly distinguishes between your main business activities and those more one-off non-core events. Helps you discern sustainable performance from lucky breaks or unfortunate incidents.
Now, companies can choose how to present their income statement.
Yeah.
I think there are two main ways. Why would they pick one over the other?
Exactly. We have the multiple-step and single-step formats. The multiple-step income statement is what you'll typically see for larger, more complex businesses.
Or detail.
A lot more detail. This approach meticulously separates operating revenues and expenses from non-operating items like interest revenue or a loss on the sale of fixed assets.
Okay.
It provides enhanced user information, allowing for easier calculation of various analytical ratios because it clearly segments core operations from incidental activities. It's like a detailed play-by-play of the company's core business performance.
So using our example, Radon Industries, Inc., how would that look in a multiple-step format? What's the real benefit for us, the audience, in seeing all those steps?
Looking at Radon Industries, Inc., example 1, you can see how it breaks down very granularly. It starts with net sales.
Top-line revenue.
Right. Total revenue from goods, services, rentals, less any returns or discounts. Then it subtracts cost of sales to arrive at the gross margin.
That's a key one.
Oh, the gross margin is a really important figure for analysts. Tells you how profitable the company is just from its direct sales activity before considering overhead.
Okay.
From there, it meticulously lists selling expenses like freight out, salesperson salaries, commissions, advertising and general and administrative expenses, or G&A.
Overhead.
Yeah, officer salaries, insurance, rent, that kind of thing. Subtracting these from the gross margin leads to income loss from operations.
Another critical number.
Absolutely, because it shows the profitability generated solely from the company's core business activities, ignoring financing costs or one-off events.
Right.
Below that, you find other revenues and gains, like interest revenue or gains on sale of investments. And on the flip side, other expenses and losses, like interest expense, losses on sale of fixed assets, or restructuring expenses.
Okay.
This detailed segmentation allows for a much more in-depth analysis of the company's operational efficiency, helps you separate the recurring profitability from less predictable items.
And flows down to?
It leads to income before income tax, then you subtract income tax expense, resulting in income from continuing operations. And finally, you might see a separate line for discontinued operations, net of tax, before reaching the ultimate net income. This enhanced segmentation allows for that detailed analysis.
In the single-step approach, how is that different, and when might a company choose that instead? Seems simpler.
The single-step income statement is, as the name suggests, much simpler.
Yeah.
It essentially takes all revenues and other gains, groups them together, subtracts all expenses and other losses, grouped together, and arrives at a single net income figure.
Just one calculation.
Basically, yes. The benefit is simplicity and ease of understanding for those who just want the bottom line.
Less intimidating, maybe.
Could be. And it avoids suggesting that one type of revenue or expense is inherently more important than another, though you do lose that detailed breakdown.
Can you walk us through the Radon Industries example in that single-step format? How does it look?
Sure. In Radon Industries, Inc., example 2, you'd see all revenues and other gains grouped together at the top. Sales revenue, service revenue, interest revenue, rental revenue, gain on sale of securities, other revenue, all lumped together, in this case totaling $1 million.
Okay, one big revenue number.
Then all expenses and other items are grouped below that. Cost of goods sold, cost of services, cost of rental income, selling expenses, G&A, interest expense, depreciation, loss on sale of assets, restructuring expense, income tax expense.
All the costs.
All the costs, which in this example total $950,000. Subtracting the total expenses from total revenues directly gives you income from continuing operations, which is $50,000.
Straight to it.
And then you'd still see discontinued operations, net of tax, reported separately below that, leading to the final net income.
Got it.
Understanding these formats helps you quickly find the information most relevant to your specific needs, whether you're a detailed analyst dissecting every line or just looking for the overall bottom line result.
Okay, here's where it gets really interesting, I think. Sometimes a company sells off a big chunk of its business. Why does accounting treat that so specially, calling it a discontinued operation? It sounds pretty dramatic.
It is dramatic,
Yeah.
and it's a critical area for understanding a company's future.
Okay.
Discontinued operations are reported separately, net of tax, precisely because they represent a strategic shift that will have a major fundamental effect on the entity's future operations and financial results.
So it's not just selling off one little thing.
No, it's not just selling off a minor asset or a single product line. It's a fundamental change in the company's business model or its overall direction.
Like what? Give me an example.
Well, it could be the disposal of all operations in a major geographical area, or selling a significant equity investment in another company, or even exiting an entire major line of business that changes the company's core identity.
A big deal now.
A very big deal. This separation ensures that when you look at income from continuing operations, you're truly seeing the performance of the business that will move forward.
Can you give us a real-world type scenario that illustrates this kind of strategic shift? Make it concrete for us.
Certainly. Think about AmServe Inc., a hypothetical food service company. Let's say they used to deliver frozen food products to various providers, including fast food restaurants.
Okay.
Historically, that fast food segment was their largest in terms of revenue and operating profit. But, public tastes shift towards healthier options.
Right.
And that division was forecasted to decline. So AmServe decides to sell its entire fast food operation to focus exclusively on selling to local restaurants offering healthier fare.
A totally new direction.
Exactly. This new segment might have lower revenue per unit, but potentially higher operating profit and better long-term growth prospects. Because the fast food division was the largest component in terms of revenue and operating profit, its disposal represents a major strategic shift for AmServe.
Okay.
It's not just trimming fat, it's reshaping the entire company's core business. So it's reported as a discontinued operation to provide a clearer view of the new ongoing business.
So investors aren't confused by past profits from a business that's just gone.
Precisely. You don't want to be forecasting future results based on a business segment that's no longer there.
So what exactly gets lumped into discontinued operations on the income statement, and when do we see it? Is it just the profit or loss from the sale itself?
It's more than just the sale. It includes 3 key things, all reported net of tax.
Okay, 3 things.
First, the results of the component's operations up to the point it's either sold or classified as held for sale, so its own profit or loss while it was still active. Second, any impairment loss if the value of the component drops below its carrying amount.
Like a write-down.
Exactly. Or a subsequent gain up to any previously recognized loss if its value recovers a bit before sale. And third, the ultimate gain or loss when the disposal actually happens.
Okay.
All of these amounts are included in discontinued operations in the period in which they occur.
And there's something about depreciation stopping.
Yes, important detail. Once a component is classified as held for sale, its assets are no longer depreciated or amortized.
Why is that?
Because the thinking is it's no longer part of the ongoing productive assets of the continuing operations. It's basically inventory waiting to be sold at that point.
Okay, that makes sense. Let's walk through a concrete example. The source provides a fantastic one with all sports company and its golf division. How would this actually look on the financial statements for year 1 and year 2? Show us the numbers.
Okay, this is a great illustration of how these strategic shifts are presented over time. Let's look at All Sports Company. They decided on April 30, year 1, to dispose of its golf division and then actually sold it on June 30, year 2.
2 different years involved.
Right. So for year 1 reporting, even though the golf division wasn't sold yet, it was classified as held for sale.
Okay.
So year 1's income statement must reflect its impact. We include the loss from operations of the golf division from the beginning of the year up to April 30. Based on the source, that's calculated as a loss of $2,400,000 from its revenues and expenses.
Wow, big loss.
Yeah. And this is reported net of the 40% tax rate, so its impact on net income is a loss of $1,440,000.
Okay.
Additionally, because the carrying value of the golf division, $4 million, was higher than its fair value, less cost to sell, $2,200,000, an impairment loss of $1,800,000 was recognized in year 1.
Another hit.
Another hit. Net of tax, this results in a $1,080,000 loss. Both of these losses, the $1,440,000 from operations and the $1,080,000 impairment loss, are presented separately below income from continuing operations for year 1.
So you see the main business, then this stuff separately.
Exactly. So you see the continuing operations income of, say, $4,875,000, and you know that's the core business, separate from the golf division's exit troubles.
Okay, now what about year 2 when they actually sell it?
Right. Moving to year 2 reporting. When the golf division is finally sold on June 30, we report 2 more things under discontinued operations.
Okay.
First, the continuing losses from operations from the start of year 2 until the sale date. The example states $200,000 per month.
Right.
So for 6 months, January to June, that's a $1,200,000 loss. Net of tax, this impacts income by $720,000.
Still losing money while waiting to sell.
Yep. Plus, there's the final loss on disposal. The division was sold for $2 million, but its fair value, less cost to sell, was $2,200,000 just before the sale, resulting in an additional $200,000 loss. Net of tax, that's a $120,000 loss. These year 2 discontinued operation losses, totaling $840,000 net of tax, are again reported separately below income from continuing operations.
Got it.
This careful, separate reporting ensures that you, the user, can clearly see the performance of the core business without the noise of a major segment that's no longer part of the ongoing strategy. It allows for better predictive analysis, right?
Yeah.
Because you're not trying to forecast future results based on a business that won't be there.
Makes perfect sense. Okay, shifting gears slightly. In our interconnected world, companies often deal with foreign currencies. What happens when a company buys or sells internationally and the exchange rate changes? This seems like it could introduce a lot of volatility.
It absolutely can. And if we connect this to the bigger picture, foreign currency transactions introduce a unique set of challenges and sometimes opportunities for gains or losses.
Right.
These occur when a company conducts business in a foreign currency where they don't have an ownership interest, like a U.S. company buying goods from a supplier in Germany and agreeing to pay in euros. If the exchange rate between the time the transaction is agreed upon and the time payment is made changes, well, it can result in either a gain or a loss for the company, even if the price in the foreign currency remained exactly the same.
So if the rate changes between when a deal is made and when payment happens, there's a gain or loss. How is that accounted for, especially if the transaction isn't settled by the balance sheet date? That seems tricky.
This is where it gets nuanced, you're right. A foreign exchange transaction gain or loss is recognized in current net income.
It's the bottom line.
Directly. If the exchange rate changes between the transaction date and the settlement date, so it impacts the company's reported profitability for that period.
Okay.
Now, if the transaction isn't settled by the balance sheet date,
All right.
the company must compute an unrealized gain or loss.
Unrealized, meaning they haven't actually paid or received cash yet.
Exactly. This is the difference between the exchange rate used when recording the original transaction in dollars and the current exchange rate at the balance sheet date. This unrealized gain or loss is also recognized in current net income in that period.
Wow, okay, so even before cash changes hands.
Even before cash changes hands. The company's financial results reflect the impact of those currency shifts as they happen, provides a more timely view.
Let's use the Alinto company example again. They bought goods on credit in pesos. How does this play out with the changing exchange rates? Walk us through the journal entries, maybe not literally, but the effect.
Okay, this is a great illustration. On December 1, year 1, Alinto Company purchased goods for 100,000 pesos when the exchange rate was $0.10 per peso.
So a $10,000 purchase and liability.
Exactly. They record the purchase, and importantly, an accounts payable equivalent to $10,000.
Got it.
Then, at December 31st, year one, the balance sheet date, the exchange rate for pesos dropped to 0.8.
Pesos got cheaper.
Right. Now, since Alinto owes 100,000 pesos, and pesos are now cheaper to acquire in U.S. dollars, they effectively have a gain on their liability.
Ah, because it costs less to pay it off now.
Precisely. The debt that was worth $10,000 is now only worth $8,000 to pay off. That $2,000 difference, $0.08 times 100,000, is recognized as a foreign exchange transaction gain, which hits net income in year one.
Even though they haven't paid yet.
Even though the payment hasn't been made, it's an unrealized gain, but it reflects a real economic improvement for the company at that moment.
Okay, then what happens in year two?
Finally, on February 1st, year two, when Alinto Company actually pays for the goods, the exchange rate has increased to $0.09 per peso.
Pesos got a bit more expensive again.
Yep. The liability on their books was previously adjusted down to $8,000 at the $0.09 rate, but now to actually pay the 100,000 pesos, it costs them $9,000 and 100,000 x $0.09.
So they lost some of that gain back.
They did. They incur a $1,000 loss, $0.08 per peso times 100,000 pesos in year two when they actually settle the debt. This $1,000 loss affects net income in year two. This shows how companies must continually adjust for these currency fluctuations, impacting their reported income, even before cash physically changes hands. It provides a real-time view of the financial impact of global transactions.
We've talked about net income quite a bit, but then there's this concept of comprehensive income. Is it just a fancier name for the same thing? Or is it truly a different measure?
Oh, not at all. Comprehensive income is a significantly broader measure. Think of it as the total change in a company's equity from non-owner sources during a period.
Total change. Okay.
While net income is a critical part, comprehensive income expands on that by adding other comprehensive income items, or OCI.
OCI.
Right. This means it captures all changes in a company's value that aren't from owners investing money into the company or taking money out through dividends. It provides a more complete, holistic picture of how the company's total economic wealth changed over the period.
Beyond just the profits from operations.
Exactly. Beyond just the profits from its core operations, it's like a super net income in a way.
So what are these other comprehensive income items, these OCI things? And why aren't they included in regular net income? Why the special treatment? It seems like they should just be in there.
Well, these are specific revenues, expenses, gains, and losses that, under U.S. GAAP, are specifically excluded from net income, but they're still vital for a complete picture of a company's financial performance and value.
But why exclude them?
The reason they're kept out of regular net income is generally because they haven't been realized yet, or they're still subject to significant future change, maybe volatility.
Okay.
Putting them directly into net income could make earnings too volatile or potentially misleading regarding the core operations performance. They represent changes in the value of assets or liabilities that are not yet locked in by a transaction, or maybe they're tied to long-term valuation shifts rather than immediate operating results.
Can you give us some examples of these key OCI items? What's an unrealized gain or loss in this context? And how is it different from the foreign exchange gains losses we just talked about, which did hit net income?
Good question. One major category is unrealized gains and losses on available-for-sale debt securities and hedges.
Okay.
An unrealized gain or loss here refers to an increase or decrease in the value of certain investments, like debt securities, that the company still holds and intends to sell in the future.
So they haven't sold them yet?
Exactly. The gain or loss isn't realized until the security is actually sold. These also include gains or losses on certain derivative instruments used for cash flow hedges, financial tools companies use to manage risks, like interest rate changes.
Okay.
These items bypass the income statement and stay in OCI until they are eventually sold or settled. At that point, they reclassify into net income.
Ah, so they eventually get there, maybe?
Potentially, yes.
Yeah.
This prevents market fluctuations of these investments from making the operating income statement look overly volatile and distracting from core business performance.
Okay, that makes sense. Now, the foreign currency part, you mentioned translation adjustments. How's that different from the Alinto example?
This is an important distinction. The foreign currency transaction gains and losses we discussed earlier, like Alinto Company buying goods in pesos and the rate changing those, go into net income.
Right.
But here, under OCI, we're talking about foreign currency translation adjustments. These arise when a U.S. company consolidates the financial statements of a foreign subsidiary that operates in its own local currency, say, euros.
Ah, consolidating a whole foreign company's results.
Exactly. The translation adjustments reflect the change in the parent company's net investment in that foreign entity due to currency fluctuations when translating the foreign subsidiary's financial statements into U.S. dollars for the consolidated report.
All right.
They stay in OCI until the investment in the foreign entity is sold or liquidated, because the economic exposure exists, but it's not a realized operational gain or loss for the parent company yet. It's more of a long-term valuation adjustment reflecting the changing dollar value of that foreign investment.
Got it. Different kind of foreign currency impact. Are there others?
Yes. We also have pension adjustments, where certain gains and losses from defined benefit pension plan accounting are parked in OCI until they are eventually recognized as pension expense over time on the income statement.
Pension accounting. Always complex.
It is. And a newer item, changes in fair value attributable to instrument-specific credit risk for certain liabilities where the company chooses to measure them at fair value. This basically captures the change in value of a company's own debt if its own creditworthiness changes. A bit nuanced.
Okay, so quite a few specific items land in OCI. If they're excluded from net income, where do they eventually end up? Do they just vanish into thin air after the year is over?
No, they don't disappear. They accumulate. They build up in a separate component of equity on the balance sheet called Accumulated Other Comprehensive Income, AOCI.
ASUA. Okay.
Think of it like a special holding pen or bucket in the equity section, totally distinct from retained earnings.
Right.
At the end of each accounting period, net income closes to retained earnings, building up the company's accumulated profits available for dividends. Similarly, the OCI items for the period close to AOCI, accumulating all these other non-owner changes in equity over time.
So you can see the running total.
Exactly. This helps keep net income focused on core operations while still providing a complete picture of all changes in equity from non-owner sources. It ensures transparency about all ways the company's value changes for its owners.
How do companies actually show all this to us, the public? What forms does this take in the reports?
Companies have two main ways to present comprehensive income. The first is the single statement approach.
Okay.
This is where the OCI items are displayed individually, right below net income, all within one continuous statement of comprehensive income.
So net income plus OCI equals comprehensive income, all in one statement.
Exactly. It provides a continuous flow, it's concise, and keeps everything in one place.
Can you give us an example of how that looks, using Sydney Technologies?
Absolutely. Looking at Sydney Technologies, Inc., example 5, you can see their statement of comprehensive income. It starts with revenues and expenses, leading down to net income, which in this case is $1,200,000.
Okay.
Immediately following net income, you'll see the other comprehensive income section. This lists items like unrealized holding gains on available for sale securities, net of tax, and foreign currency items, also net of tax.
Right.
These OCI amounts are added or subtracted from net income to arrive at the total comprehensive income figure, which for Sydney Technologies is $1,357,500. Everything is contained neatly in one report, showing a clear bridge from traditional earnings to the broader measure.
Okay, that seems clear. What's the other way?
The second method is the two-statement approach.
Two statements.
Yep. This involves a traditional income statement ending with net income, and then immediately following it, a separate statement of comprehensive income that starts with that net income figure from the first statement, and then adds or subtracts the OCI components to get to comprehensive income.
Ah, so you have the regular income statement and then another short one showing the OCI adjustments.
Exactly. This is also illustrated by Sydney Technologies, Inc., example 5, where the separate statement of comprehensive income simply begins with net income and then proceeds to list the OCI items to reach the same comprehensive income total.
Same result, just presented differently.
The effect is the same. It's just a matter of presentation choice. Both are allowed under GAAP.
Are there any specific details companies must disclose about this? Because this level of detail sounds like it could get pretty granular and maybe hide things if not disclosed properly.
Yes, there are several key disclosures required to ensure full transparency. Companies must disclose the tax effects of each OCI component. They can show this either directly on the statement itself, next to each item, or in the notes to the financial statements.
Okay, tax impact is important.
Very. They also need to show how the accumulated balances of each OCI component have changed from period to period, essentially, a reconciliation of the AOCI account, breaking it down by type.
Like a mini statement for AOCI itself.
Pretty much. And The total AOCI must be presented clearly in the balance sheet as a separate item within stockholders' equity, reflecting its cumulative impact over the years.
Okay.
Lastly, and very importantly, they have to disclose reclassification adjustments.
Reclassification. What's that?
These adjustments are made to avoid double counting items that were previously recognized in OCI but are now being recognized in net income in the current period.
Ah, like when they finally sell that available for sale security.
Exactly. That unrealized gain that was sitting in OCI now becomes a realized gain and hits net income. A reclassification adjustment removes that item from OCI as it moves to net income, so it's not counted in both places in the same period.
Prevents double counting. Makes sense.
This level of detail means you, the user, can trace how value is accumulating or being lost, even if it's not directly hitting the traditional bottom line yet. Provides a very transparent view of total changes in equity.
Okay, great. Moving from the statements themselves, let's talk about who sees them and how. For public companies, the SEC steps in, right? What are these required SEC reports for, and why are they so crucial for investors?
Precisely. The Securities and Exchange Commission, the SEC, mandates various forms to ensure transparency for investors and the public.
Keeping companies honest.
That's the idea. These reports are how companies provide detailed insights into their business, risks, and financial results. It's really about empowering current and prospective investors with crucial information to make informed decisions.
Where do we find these?
These forms, which are publicly available through the SEC's ADGR system online, provide a standardized way for everyone to access and analyze company data. It really democratizes financial information.
The big one is the 10K, right? What's in it, and why is it so important for someone looking to understand a company deeply?
The Form 10K is the comprehensive annual report. It's essentially the flagship financial disclosure for U.S. registered companies, a deep dive into the entire year.
The big enchilada.
You could say that. Beyond the audited financial statements, which include balance sheets for the 2 most recent fiscal years, and income statements, statements of comprehensive income, cash flows, and changes in owner's equity for the 3 most recent fiscal years.
3 years for income, okay.
It also includes crucial qualitative information. A key part is management's discussion and analysis, or MD&A.
MD&A, I've heard of that.
It's where management provides their own narrative perspective on the company's financial condition and results of operations. It gives context and forward-looking insights on things like liquidity, capital resources, trends, uncertainties, stuff the numbers alone might not convey.
Management story.
Exactly. It's where management tells their story of the year. It also includes quantitative and qualitative disclosures about market risk, outlining potential losses from changes in interest rates, exchange rates, commodity prices, etc.
Risk factors.
Yep. This report is invaluable because it wraps up all the essential details about the company's performance, position, and future outlook. And critically, it's all verified by an independent auditor's report and certified by the CEO and CFO.
So it's audited and signed off on.
Okay.
And the 10Q, is that just the same stuff but more frequent?
Similar, but quarterly and generally unaudited. Form 10Q provides an ongoing overview of operations and financial statements for each of the first 3 fiscal quarters of the year.
Quarterly updates.
Right. While it's often in a condensed format compared to the 10K, it updates on material changes since the last fiscal year end. It includes updated financial statements, often condensed, and a quarterly MD&A section.
Still useful, huh?
Very useful for timely information. The deadlines are also much tighter, 40 or 45 days after quarter end, depending on the company's size, ensuring more timely info flow. Think of it as a quarterly progress report.
What about the 8K? That sounds like breaking news, like urgent.
That's exactly it. The Form 8K is filed whenever a material event occurs, something significant that investors would need to know promptly.
Like what kind of event?
Oh, things like a company filing for bankruptcy, a major acquisition or disposition of assets, maybe changes in the public accounting firm used to audit the company, or significant changes in directors or key executives.
Big news.
Big news. Companies typically have just 4 business days to file it after the event occurs. So it's a critical tool for real-time disclosure of information that could impact investment decisions.
Wow, 4 days is fast.
It is.
Right.
These forms 10K, 10Q, 8K are literally packed with information, offering different levels of detail and immediacy. Knowing about them helps you know where to look for specific answers about a company's operations, sometimes in real time.
Okay, that's super helpful context. Now, one number that every investor pays attention to, it seems, is earnings per share, or EPS. Why is this figure so critical for understanding a company's profitability? What's the big takeaway for us?
EPS is absolutely foundational because it boils down a company's profitability to a single per-share figure.
Simple number.
Right, which makes it incredibly easy to compare profitability across different companies or track it over time for the same company, especially for publicly traded entities.
Okay.
It directly answers the question, how much profit does the company make for each outstanding common share? All public entities are required to present EPS right on the face of the income statement.
Front and center.
Front and center. And if they report a discontinued operation, the per-share amount for that item must also be presented separately. The real insight often comes not just from the number itself, but its trend over several periods or how it stacks up against competitors. Is growth sustainable or just a one-off bump?
And I hear there's basic and diluted EPS. What's the difference there, and why do companies sometimes have to report both?
Yes. The distinction depends entirely on a company's capital structure.
Okay.
If a company has a simple capital structure, meaning it only has common stock outstanding, maybe some non-convertible preferred stock, but nothing else that could become common stock.
Nothing tricky.
Right. Then it only reports basic EPS. That's the most straightforward calculation.
Okay.
However, if it has a complex capital structure, meaning it has other securities out there that could potentially become common stock, like convertible bonds, convertible preferred stock, stock options, warrants.
Things that could turn into shares.
Exactly. Then it must report both basic and diluted EPS.
Why both?
This is crucial for showing the potential dilutive effect. Diluted EPS shows how much earnings per share could be reduced if all those potential common shares were actually converted or exercised.
Kind of a worst-case scenario for existing shareholders.
That's a great way to put it. Diluted EPS essentially presents a worst-case scenario from the common shareholder's perspective, giving a more conservative view of future earnings if all those other claims were to convert into common stock.
Let's start with basic EPS then. What's the core formula, and how do we get to that income available to common shareholders part? Seems important.
It is. Basic EPS is simply income available to common shareholders divided by the weighted average number of common shares outstanding.
Okay, income divided by shares. Sounds easy.
The concept is, but calculating the numerator, income available to common shareholders, needs care. It's not just net income.
Right.
You take net income, and then you have to deduct any dividends declared in the period on non-cumulative preferred stock.
Okay.
And crucially, for cumulative preferred stock, you deduct the dividends accumulated for the period, even if they haven't been declared yet.
Even if not declared. Why?
Because those cumulative preferred shareholders have a claim on those earnings for the period, whether paid out or not. Their claim comes before common shareholders. This ensures we're only looking at the portion of income that truly belongs to or is available for the common shareholders.
Got it. What if there's a loss?
Good question. If a company has a net loss, the loss amount available to common shareholders is actually increased by these preferred dividend claims. Makes the per-share loss look worse for common holders.
Okay, that numerator makes sense now. What about the denominator? This weighted average number of common shares outstanding. That sounds tricky. Why can't we just use the number of shares at year-end? Seems simpler.
It would be simpler, but less accurate, because shares can be issued or reacquired by the company throughout the year, changing the number of shares outstanding from day to day.
Right. Companies issue shares, buy them back.
Exactly. If a company issues new shares in July, those shares were only outstanding for half the year. You can't just count them as if they were there all year earning profit.
Okay.
The weighted average accounts for the portion of the period those shares were actually outstanding. It time weights the shares.
Makes sense.
And it also retroactively adjusts for stock dividends and stock splits. It treats them as if they occurred at the beginning of the earliest period presented.
Why retroactive?
For comparability, stock dividends and splits don't change the total economic ownership, just the number of pieces the pie is divided into. Adjusting retroactively ensures EPS figures are comparable across different reporting periods, even after a split.
Got it. So the denominator truly represents the average shares that could have benefited from the income generated throughout the entire period.
That's the goal. Accuracy and comparability.
Now, for the complex part, diluted EPS. What's its ultimate goal? And what's the key idea of dilutive versus anti-dilutive? You mentioned that earlier.
Right. The objective of diluted EPS is to measure performance while giving effect to all potentially dilutive common shares outstanding during the period.
All potential shares.
All potential shares that would reduce EPS if converted or exercised. It's that what-if scenario we talked about, showing the worst-case dilution if all these convertible securities or options jump into the common stock pool. It provides a more conservative estimate of per-share earnings.
Okay, and dilutive versus antidilutive.
This is absolutely key. A security is dilutive if assuming it converts or is exercised would reduce EPS compared to basic EPS.
Makes EPS go down?
Right. If assuming it converts would increase EPS, it's antidilutive. And critically, antidilutive securities are excluded from the diluted EPS calculation.
Why exclude them?
Because the goal is always to present the most conservative or lowest possible EPS figure to investors. Including something that makes EPS look better would defeat the purpose of showing maximum potential dilution.
Gotcha. So you only factor in the things that make EPS worse.
Exactly. And we consider each potentially dilutive security separately, usually ranking them from most dilutive to least, to ensure the maximum possible dilution is reflected in the final number.
How do stock options or warrants affect diluted EPS? I hear there's a treasury stock method. Sounds like something we discussed earlier.
It relates, yes. For options and warrants, we use the treasury stock method. This method assumes that if options or warrants were exercised, the company would receive cash from the exercise price. Then it assumes the company uses that cash to buy back its own common shares from the market at the average market price during the period.
So shares go out from the option exercise,
Right.
but some shares come back in from the buyback.
Precisely. The formula essentially calculates the net increase in shares. It's the number of shares that would be issued upon exercise minus the number of shares that could be repurchased with the cash proceeds.
Can you give a quick example?
Sure. Say 1,000 options are exercisable at $15 and the average market price is $20. Exercising gives the company $15,000. 1,000 x $15. With that $15,000, they could theoretically buy back 750 shares, $15,000 $20 AV price.
Okay.
So 1,000 shares go out, 750 come back in. The net increase in shares for the diluted EPS denominator is 250 shares, 1,750.
Clever way to estimate the net effect.
It is. It estimates the net dilutive effect without assuming the company actually does the buyback. And importantly, if the exercise price is higher than the average market price, the options are out of the money. They wouldn't be exercised in reality, and mathematically, they'd be antidilutive, so they are excluded from the calculation.
Makes sense. What about convertible bonds or convertible preferred stock? How are they handled? A different method.
Yes, for those we use the if-converted method.
Oh, if converted, okay.
This method assumes that the convertible securities were converted into common stock at the beginning of the period or at their issue date, if later.
Assume they converted right away.
Right. And this affects both the numerator, income available to common shareholders, and the denominator, weighted average shares outstanding, to reflect this hypothetical conversion.
Well, let's take convertible bonds first. How does the if converted method affect both parts of the EPS calculation?
Okay, if convertible bonds were converted, the company would no longer be paying interest on them.
Right. No more interest payments.
So in the numerator, we add back the interest expense related to those bonds, but importantly, net of tax to the income available to common shareholders, because that interest would no longer be a tax-deductible expense if the bonds were equity.
Add back the after-tax interest saved.
Got it.
And the denominator.
In the denominator, we simply add the number of common shares that would be issued upon conversion of those bonds to the weighted average shares.
Okay. Let's use that X company example again. Bonds convertible into 5,000 shares. After-tax interest is $19,800. Basic EPS is $1. What happens?
So for diluted EPS, we'd add $19,800 back to the net income available to common shareholders, the numerator, and we'd add 5,000 shares to the weighted average shares outstanding, the denominator.
Okay.
After making these adjustments, we calculate the hypothetical diluted EPS. Now, remember the anti-dilution test. In this specific example from the source, if basic EPS was $1 and the hypothetical diluted EPS after adding back interest and shares came out to, say, $1.14,
It went up.
it went up. So these convertible bonds would actually be anti-dilutive in this case because their inclusion increased EPS.
So you wouldn't include them in the final diluted EPS number.
Correct. They are then excluded from the final diluted EPS calculation reported to the public. This highlights the importance of that anti-dilution check. We only include securities that truly reduce EPS to show the most conservative figure.
Very important check. And convertible preferred stock. Similar logic with the if converted method.
Very similar logic, yes. If convertible preferred stock were converted, preferred dividends would no longer be paid on it.
Right, because they're common shareholders now.
Exactly. So we add back the preferred dividends to the numerator. Remember, for basic EPS, we subtracted preferred dividends. Here, we don't subtract them or add them back if they were already subtracted because they wouldn't have been paid if the stock was converted.
So the full net income is available to common holders in this scenario.
Correct, for that portion. And in the denominator, just like with bonds, we add the common shares that would be issued upon conversion of the preferred stock. Anti-dilution rules apply here too.
Can you illustrate with Carlin Company's preferred stock? Net income $100K, preferred dividends $20, converts to $50K common shares. Basic EPS was 0.80 cents.
Okay. For basic EPS, the numerator was $80,000, 100K, 20K. For diluted EPS using the if-converted method, we assume conversion. So those $20,000 preferred dividends are not subtracted from the net income in the numerator calculation. The numerator becomes the full $100,000 net income.
Okay.
In the denominator, we add the 50,000 common shares from the potential conversion to the existing weighted average common shares.
Got it.
Now, we calculate the diluted EPS. If the result is, say, 67 cents per share, we compare it to the basic EPS of 80 cents.
This 67 cents is lower than 80.
It is. So in this case, the convertible preferred stock is dilutive, and it is included in the diluted EPS calculation reported. This subtle adjustment for preferred dividends is a key detail.
Definitely shows how diluted EPS gives that more conservative view. Are there specific disclosure requirements around EPS?
Yes, absolutely. Companies must disclose reconciliations of the numerators and denominators used for both basic and diluted EPS, basically showing their math clearly.
Transparency.
Exactly. They also disclose the effect of preferred dividends on basic EPS, and importantly, they must identify any potentially dilutive securities that were not included in the diluted EPS calculation because they were anti-dilutive for the period presented.
So you know what could have diluted it but didn't.
Right. This comprehensive disclosure helps you fully understand the EPS calculation and its implications. It's about providing the full context of what drives that all-important per-share number.
Okay, fantastic. Now, to tie it all together, let's look at the third major part of the balance sheet, stockholders' equity. This is where the owner's stake in the company lives, right? It's where all the earnings eventually accumulate or don't.
Precisely. Stockholders' equity represents the owner's claim to the net assets of a corporation. That is, its assets minus its liabilities. It's the residual interest.
What's left over for the owners?
Exactly. It's typically the last major section on the balance sheet, and it must clearly classify the various sources of this capital, distinguishing between amounts contributed directly by owners and amounts accumulated from the company's past earnings.
Like that Capital Core example.
Yes, an example like Capital Core would list out the various components: capital stock, additional paid-in capital, retained earnings, accumulated other comprehensive income, our friend AOCI again, and treasury stock, which is a reduction. Understanding these components is absolutely key to knowing how a company has been financed by its owners and how that financing structure has evolved over time. It's like the owner's savings and investment account for the business.
You mentioned capital stock. I also hear the term legal capital. What's legal capital? It sounds kind of old-fashioned.
It does sound a bit formal. Legal capital is essentially the minimum amount of capital that must be retained by the corporation for the protection of its creditors.
A safety net for lenders.
Sort of. It's usually the par or stated value of the issued stock. It sets a baseline amount that the company cannot simply distribute away to shareholders through dividends or excessive buybacks. It's a foundational safeguard, ensuring there's a basic cushion of capital.
And terms like authorized, issued, and outstanding shares. What do they mean, and why should we care about the differences between them?
These are crucial for understanding a company's stock structure and how many shares are truly circulating in the market.
Okay.
Authorized shares are the maximum number of shares a company is legally allowed to issue, as specified in its corporate charter or articles of incorporation. It's the maximum potential pool.
The ceiling.
Right. Issued shares are those shares from that authorized pool that have actually been sold or distributed to shareholders at some point.
Okay, shares that went out the door.
Exactly. Now, a company can sometimes buy back its own shares, which we call treasury stock. So outstanding shares are those shares that have been issued and are currently held by shareholders. This excludes treasury stock.
So issued minus treasury stock equals outstanding.
Generally, yes. Knowing these numbers helps you understand how many shares are potentially available to be sold in the future, how many are currently out there affecting calculations like EPS, and how many are actively trading in the market.
Common stock is pretty straightforward, right? It's the basic ownership, the main type of stock for most companies.
Yes, it represents the basic ownership interest in a corporation. Common shareholders bear the ultimate risk of loss if the company goes bankrupt. They're last in line.
Right.
But they also receive the ultimate benefits of success. They get what's left after all other claims are settled.
High risk, high reward potential.
Potentially. They typically have voting rights, allowing them to elect the board of directors and influence corporate policy, a powerful right. They also have a right to share in the earnings of the corporation through dividends, if declared, and to share in assets upon liquidation, but only after creditors and any preferred shareholders have been satisfied.
And sometimes they have preemptive rights.
Yes, they may have preemptive rights if granted in the Articles of Incorporation. This gives them the right to buy newly issued shares, usually in proportion to their current holdings, before they're offered to the public. Helps them maintain their ownership percentage, preventing their stake from being diluted by new issuances.
Okay. There's also book value per common share. How do we calculate that, and what does it really tell us about a company's value? Is it useful?
Book value per common share measures what common shareholders would theoretically receive for each share if all the company's assets were sold at their book values, the values on the balance sheet, and all liabilities were paid off.
Okay, the accounting value.
Exactly. It's calculated as common shareholders' equity divided by common shares outstanding.
And how do you get common shareholders' equity?
You take the total shareholders' equity from the balance sheet and subtract the equity related to preferred stock. That usually means subtracting the preferred stock outstanding, the greater of its call price or par value, and also subtracting any cumulative preferred dividends in arrears. What's left is the equity attributable to common shareholders.
So what's its value? Is it the true value?
While it's a book value, based on historical costs and accounting rules, not current market prices, it provides a baseline understanding. It shows the company's underlying net asset value attributable to common shareholders according to the accounts. It's not market value, but it can be a useful comparison point, especially against the market price or for tracking trends over time.
Got it. Now, preferred stock sounds like it gets special treatment. What makes it preferred? Why would a company issue it?
It certainly does get preferential treatment. Preferred stock comes with certain preferences over common stock, usually regarding dividends and liquidation.
Okay.
They often receive a fixed dividend rate, and those dividends must be paid before common shareholders receive anything.
Priority on dividends.
Yes. And in the event of liquidation, preferred shareholders have a claim to the company's assets before common shareholders get anything back.
Priority if things go wrong, too. What's the catch?
Typically, preferred stock does not have voting rights. So shareholders trade control for these preferences, less risk and more predictable income, potentially, but less control and usually limited upside compared to common stock. Companies might issue it to raise capital without diluting the voting control of common shareholders, or because it appeals to a different type of investor seeking stable income.
What's the deal with cumulative dividends for preferred stock? You mentioned dividends in arrears.
Right. If preferred stock is cumulative, any dividends that the company misses paying in a given year accumulate as dividends in arrears.
Then pile up.
They pile up, and all those past due dividends must be paid in full before any future dividends can be distributed to common shareholders. It's like a running tally of unpaid promises that common shareholders are on the hook for before they can get anything.
And if it's non-cumulative?
If it's non-cumulative, those missed dividends are just lost forever. If the board doesn't declare and pay the preferred dividend in a specific year, the shareholders have no right to it later. Poof, gone.
Big difference for investors.
Huge difference. It's important to note that dividends in arrears aren't a legal liability on the balance sheet until they are formally declared by the board. But they must be disclosed, usually in the footnotes, because they represent a significant potential claim on future earnings that affects common shareholders.
And participating preferred stock. That sounds like preferred shareholders might get even more than their fixed dividend.
They potentially can. Participating preferred shareholders have the right to share in excess dividends with common shareholders beyond their fixed preference amount.
How does that work?
If it's fully participating, they typically share in any extra dividends proportionally with common shares, once both common and preferred have received a basic dividend amount, like the preferred rate applied to common par value. So preferred get their initial fixed dividend, then common get a matching rate, and then anything left over is split between them based on their total par values.
So they get their preference and a piece of the extra pie.
In essence, yes. Non-participating preferred shareholders, on the other hand, are limited to only their fixed dividend amount. They don't share in any extra distributions beyond that, no matter how profitable the company is.
Okay, let's use that Samuel Co. example. Fully participating, 8% cumulative preferred. How would a $101,000 dividend be split in year 2, assuming year 1 dividends were missed?
Okay, good example. First, since it's cumulative, you pay the year 1 preferred dividends in arrears. Let's say that's $8,000.
Catch up on the missed payment.
Right. Then you pay the current year 2 preferred dividend preference, another $8,000. So that's $16,000 total to preferred so far. Then, common shareholders get a basic dividend at the same rate, 8%. Let's say the par value of common stock is $200,000, so they get $16,000.
Matching rate for common.
Right. Now, we've distributed $32,000, $16K preferred plus $16K common. We started with $101,000, so there's $69,000 remaining to distribute.
Okay.
Since it's fully participating, this remaining $69,000 is shared between preferred and common shareholders based on the total par value of each class of stock. If preferred has $100 K par and common has $200 K par, total $300, preferred gets 1/3, $23,000, and common gets 2/3, $46,000 of the remaining.
Wow, so preferred ends up getting quite a bit more than just their 8%.
In this participating scenario, yes. It shows the detailed hierarchy and how participation works. Preferred got 16K plus 23K equals 39K. Common got 16K plus 46K equals 62K.
Are there other preferred stock features we should know about?
Briefly, yes. They often have a liquidation preference, specifying the amount they get paid before common stock if the company liquidates, often par value plus any dividends in arrears. They can be convertible, allowing the holder to exchange them for a set number of common shares, or callable or redeemable, meaning the company has the right to buy them back at a specified price, often slightly above par.
Lets the company get rid of them if needed.
Right. And one really important point. Mandatorily redeemable preferred stock, where the company must buy it back by a certain date, is actually classified as a liability, not equity.
A liability, why?
Because it has a fixed maturity date and an obligation to pay, just like debt. It doesn't represent permanent capital in the same way other equity does.
Interesting distinction. Okay, so if capital stock is usually the par value, what's this additional paid-in capital or APIC line item?
APIC is essentially the amount of capital contributed by shareholders in excess of the par or stated value of the stock.
The amount paid above par.
Exactly. When a company sells its stock for, say, $10 per share, but the par value is only $1, the $1 goes to capital stock, and the extra $9 goes into additional paid-in capital, API.
Okay.
It's often aggregated into one amount on the balance sheet, combining excess over par from common and preferred stock. AP can also arise from other transactions, not just selling stock above par, things like gains on treasury stock sales, or even when shareholders donate assets or stock back to the corporation. It represents the value contributed by owners beyond the strict legal capital minimum.
Got it. Now, retained earnings, that's the accumulated profits a company hasn't paid out as dividends, right? The company's piggy bank built up over time.
Exactly. Retained earnings represent the accumulated earnings, net income, or losses, which would create a deficit over the entire life of the company, minus any dividends that have ever been paid out to shareholders.
The running total of kept profits.
Right. It's affected by net income or loss each year, any dividends declared, whether cash, property, or stock dividends, and sometimes by prior period adjustments for errors or retrospective accounting changes required by new standards. It's the total earnings a company has held onto over its history to reinvest in the business, pay down debt, or keep for future opportunities rather than distributing back to owners.
And sometimes you see appropriated retained earnings. What's that all about? Sounds like they're earmarking it.
That's exactly what it is. It's management, or sometimes a contractual requirement, setting aside a portion of retained earnings. This is purely an internal disclosure on the balance sheet or in the notes.
Why do it?
It indicates that a certain amount of retained earnings is restricted and not available for dividend distribution. This restriction might be for legal or contractual reasons, like a bond indenture agreement requiring a portion of earnings to be set aside as long as the bond is outstanding. Or it might be a discretionary act by the board for specific future purposes, like funding a planned factory expansion.
Does it mean the cash is set aside?
No, critically, it does not mean the cash itself is segregated. It's just an internal designation, a signal about the intended use of those accumulated earnings, limiting what can be paid out as dividends. It's purely a disclosure within the equity section.
Okay. And just to connect back, AOCI is also part of equity, but separate from retained earnings.
Absolutely. Accumulated other comprehensive income, holding those unrealized gains losses, pension adjustments, foreign currency translation adjustments, is a distinct component of shareholders' equity. Those items specifically bypass net income, so they don't flow into retained earnings. They accumulate in their own separate AOCI bucket within equity. This ensures the balance sheet provides that full picture of all changes to owners' equity from both operating activities via retained earnings and those other non-owner, often unrealized sources via AOCI.
Great clarification. Now, companies sometimes buy back their own stock, treasury stock you called it. Why do they do that, and how does it show up? It seems counterintuitive to buy back what you've already sold.
It might seem that way, but it's very common practice. Treasury stock is a company's own stock that has been issued to shareholders and subsequently reacquired by the company, but not retired or canceled.
So they hold on to it.
Yes. These shares are no longer considered outstanding, they don't have voting rights, and they don't receive dividends while held by the company.
Why buy them back then?
Companies do it for several strategic reasons. It can boost earnings per share, EPS, by reducing the number of outstanding shares in the denominator.
Financial engineering a bit.
Can be seen that way. It can also signal management's confidence they believe the stock is undervalued. It might be used to reduce the number of shares available for a potential hostile takeover. Or, very commonly, companies buy back shares to have them available for employee stock options or other compensation plans, or for future acquisitions using stock.
Okay, several reasons. How does it show up on the balance sheet?
It shows up as a reduction in stockholders' equity. It's a contra-equity account. And depending on state law, a portion of retained earnings equal to the cost of the treasury stock purchased may even become restricted from being used for future dividends while those shares are held.
And there are two main ways to account for treasury stock, correct? You mentioned the cost method is dominant.
Yes, there's the cost method and the legal or par-stated value method. You should definitely focus on the cost method as it's used by about 95% of companies.
Okay, cost method it is.
The primary difference between the two lies in when the gain or loss on treasury stock transactions is recognized within stockholders' equity. But it's critical to remember, under both methods, these gains and losses on treasury stock are always recorded as a direct adjustment to stockholders' equity, usually APIC or retained earnings, and are never included in the determination of net income.
Never hits the income statement. Got it.
Right. Treasury stock transactions don't impact the company's reported profitability, only its equity composition and the number of shares outstanding.
So let's dive into the cost method. How does it work, step by step? And what should we understand about how it affects the financial statements?
Okay. Under the cost method, treasury shares are simply recorded and carried on the balance sheet at their reacquisition cost.
Whatever they paid to buy them back.
Exactly. A gain or loss is only determined and recorded when the treasury stock is later reissued, sold back to the market, or formally retired. The original price the stock was issued at doesn't matter for the treasury stock account itself under this method.
Okay, so what happens when they buy back shares using the cost method?
When a company buys back shares, cash goes down, and the treasury stock account, that contra equity account, goes up by the total cost paid for the shares. The net effect is that total stockholders' equity is reduced.
Equity shrinks.
Yeah.
What if they resell those shares later for more than they paid?
If those shares are later resold for more than their buyback cost, cash goes up by the proceeds, the treasury stock account goes down by its original cost, what they paid to buy it back, and the difference, that gain, is recorded as an increase in additional paid-in capital from treasury stock, APIC-TS.
So the profit goes straight to APIC, not income.
Correct. It's a direct addition to equity. However, if those shares are resold for less than their buyback cost,
So they take a loss.
right, cash goes up by the proceeds, treasury stock goes down by its cost. That loss first reduces any existing balance in the additional paid-in capital from treasury stock account from previous profitable treasury stock sales.
Uses up previous gains first.
Exactly. If that APIC-TS account isn't large enough to absorb the entire loss, or if it's zero, then any remaining loss reduces retained earnings directly.
Hits retained earnings eventually if the loss is big enough.
Yes. The key takeaway here is that neither buying back nor reissuing Treasury stock under the cost method can increase the company's reported net income. It's all managed within the equity section, reflecting changes in the owner's stake, not operational profit.
What about that legal par value method? Just briefly, how's it different?
Briefly, the legal par value method treats the buyback more like a retirement. When shares are repurchased, it immediately reduces the original capital stock, par value, and the original additional paid-in capital associated with those specific shares. Any difference between the repurchase price and the original issuance price is adjusted through APIC from Treasury stock or other sources, and potentially retained earnings right away. Gains losses are effectively recognized upon repurchase rather than reissuance.
More complex accounting.
A bit more complex, yes. But the end result on total stockholders' equity is the same as the cost method. Just the internal breakdown of the equity accounts looks different. And again, no impact on net income.
Okay, cost method is the main one to know.
Yeah.
You mentioned donated stock, too. That sounds odd.
It is a bit quirky. Donated stock is when a shareholder gives shares of the company's own stock back to the company for free.
Why would they do that?
Various reasons, perhaps to help the company's balance sheet or signal support. This transaction doesn't change total shareholders' equity at the moment of donation. However, it does decrease the number of shares outstanding, which increases book value per share. The company records the donated stock at its fair market value on the date of donation, with a corresponding credit to additional paid-in capital.
Free equity, almost.
In a sense. If the company later sells that donated treasury stock, the cash proceeds increase assets, treasury stock is removed, and any difference between the sales price and the recorded fair market value adjusts additional paid-in capital again. Still no impact on net income.
Okay. Beyond treasury stock, how do companies issue new shares generally?
Well, new shares, beyond reissuing treasury stock, can be issued at par value, above par value, creating APIC, as we discussed, or sometimes even below par value, though that's less common and can have legal issues.
Right.
Companies might also use stock subscriptions. This is like selling shares on an installment plan. Investors agree to buy shares but pay over time. The stock certificate usually isn't issued until the full payment is received.
Okay.
Additionally, companies might issue stock rights to existing shareholders, giving them the opportunity, the right, to buy additional newly issued shares, often at a discount to the current market price. This helps existing shareholders maintain their proportionate ownership percentage if they exercise the rights, preventing dilution from the new share issuance.
Let's talk more about dividends again. Most people think of cash dividends, but you mentioned other kinds earlier. Can we recap those and the key dates involved for any type of dividend?
Absolutely. First, the dates are crucial. There are 3 important dates.
3 dates.
1, the declaration date. This is when the company's board of directors formally approves and announces the dividend. On this date, it becomes a legal liability for the company. They record dividends payable, a liability, and reduce retained earnings.
The commitment is made.
Exactly. 2, the record date. The board specifies a future date. Shareholders who are registered as owning the stock on this specific date will receive the dividend. If you buy the stock after the record date, you don't get that particular dividend.
What cutoff date?
Right. And 3, the payment date. This is the actual date when the dividend cash or other asset is dispersed by the corporation or its paying agent to the shareholders who are on record.
Cash goes out the door.
Correct. Now, for the types beyond cash, while cash dividends are most common, companies can also issue property, in-kind, dividends.
Property, like inventory.
Could be inventory, could be investment securities they hold, maybe even real estate in rare cases. They distribute non-cash assets to shareholders.
How does that work accounting-wise?
On the date of declaration, the property to be distributed must first be restated to its current fair market value. Any gain or loss from that revaluation compared to its book value is recognized in the company's income statement immediately before recording the dividend. Then, the dividend liability and the reduction to retained earnings are recorded at that fair market value.
Interesting. Gain-loss hits income first. What else?
Scrip dividends. This is basically an IOU. The corporation commits to paying a cash dividend at a later date, issuing a scrip or promissory note instead of cash immediately. Usually done when cash is temporarily tight. It creates a notes payable instead of dividends payable. Some scrip dividends even bear interest.
A promise to pay later. And the last one.
Liquidating dividends. These are crucial to understand. These occur when the total dividends declared exceed the company's balance in retained earnings.
Paying out more than they've earned cumulatively.
Exactly. This means the company isn't just distributing profits, it's actually returning a portion of the shareholders' original contributed capital from paid-in capital accounts. Such dividends reduce total paid-in capital. It's a signal that the company might be shrinking, selling off assets, or undergoing a significant change as it's returning the initial investment, not just distributing profits from operations.
Good to know. And then there are stock dividends, where companies give out more shares instead of cash. How's that different from a stock split? They sound similar.
They do sound similar, but the accounting is different depending on the size. Stock dividends are distributions of additional shares of a company's own stock to its existing shareholders, pro rata.
More shares, same company.
Right. Their accounting treatment depends on whether it's considered a small or large stock dividend relative to the total shares outstanding before the dividend.
Okay, what's a small one?
A small stock dividend is generally defined by GAAP as less than 20% to 25% of the shares previously outstanding. The assumption here is that such a small distribution won't significantly affect the market price per share.
Okay. How's it accounted for?
In this case, the fair market value of the distributed stock at the date of declaration is transferred out of retained earnings. Part of that value goes to capital stock for the par value of the new shares, and the rest goes to additional paid-in capital.
So retained earnings goes down by the market value.
Correct. Importantly, total shareholders' equity doesn't change at all. It's simply a reclassification or capitalization of retained earnings moving value from the retained earnings bucket into the paid-in capital buckets, capital stock and AP. It's like taking money from one pocket of equity and moving it to another.
Okay. And a large stock dividend.
A large stock dividend is typically defined as more than 20% to 25% of the previously issued shares. Here, the distribution is so significant that it is expected to reduce the market price per share proportionately.
Like a split, almost.
Exactly. Because of this, it's treated more like a stock split for accounting purposes. For a large stock dividend, only the par, or stated value of the newly issued shares, is transferred from retained earnings to capital stock.
Only par value moves, not market value.
Correct. Retained earnings is reduced only by the par value of the shares issued. There's no impact on additional paid-in capital. Again, total equity doesn't change, but the amount moved out of retained earnings is much smaller than for a small stock dividend based on market value.
Interesting distinction based on size. Why the different treatment?
The distinction between small and large stock dividends reflects whether the market price is expected to be materially affected. If not, small dividend, you capitalize market value to reflect the value distributed. If it is large dividend, it's more like a split, so you just adjust for the par value of the new shares created.
Finally, stock splits themselves. How are they fundamentally different from stock dividends, especially large ones, and how do they impact shareholders and the books?
A stock split is even simpler from an accounting perspective. It simply increases the number of shares outstanding and proportionately reduces the par, or stated value per share. For example, in a 2-for-1 stock split, a shareholder gets 2 shares for every one they previously owned, but the par value per share is cut in half.
More shares, lower par value.
Exactly. Crucially, there's no change in the dollar amounts in any of the stockholders' equity accounts, capital stock, APIC, or retained earnings. Total equity remains the same. Total par value outstanding remains the same, twice the shares at half the par. It's usually just a memo entry in the accounting records to note the change in the number of shares and the new par value.
No journal entry needed.
No formal dollar journal entry. It's like cutting a pizza into more slices. You have more slices, but the total amount of pizza, total equity hasn't changed.
And a reverse split.
A reverse stock split does the opposite. It reduces the number of shares outstanding and increases the par value proportionally. Again, no change to the total dollar amounts in equity.
Why do companies do splits?
Usually to adjust the stock's trading price. A regular split makes the price per share lower, potentially making it more attractive or accessible to a wider range of investors. A reverse split increases the price per share, which might be done to meet stock exchange listing requirements or make the stock look less like a penny stock.
And do splits or stock dividends apply to treasury stock?
Generally, no. Stock dividends and stock splits are typically applied only to outstanding shares, not to shares held in the treasury by the company itself.
Okay, so with all these potential changes happening within equity net income, OCI, dividends, stock issuance, treasury stock, it seems like a lot to keep track of. Is there one place that summarizes all of this?
Yes, exactly. All these transactions and movements within the ownership structure are comprehensively summarized in the statement of changes in shareholders' equity.
The final statement we mentioned at the start.
Right. This statement provides a detailed reconciliation of the beginning and ending balances for each major equity component. Capital stock, broken down by class, like common and preferred, additional paid-in capital, retained earnings, and accumulated other comprehensive income, often showing detail by type within AOCI, and treasury stock.
Shows the whole story of equity for the period.
Precisely. It clearly shows all the transactions that affected these accounts during the period, net income flowing into retained earnings, OCI flowing into AOCI, any stock issuances increasing capital stock and APIC, all distributions to shareholders like cash or stock dividends reducing retained earnings, and treasury stock repurchases or reissuances affecting treasury stock and potentially APIC or retained earnings.
The ultimate summary.
It really is. It's the ultimate summary of the owner's stake and how it changed over time, offering a complete picture of the dynamics within equity. It effectively connects the income statement, net income, and the statement of comprehensive income, OCI, to the ending balance sheet equity section, showing exactly how the company got from the beginning equity balance to the ending balance.
Wow. What a deep dive that was into the world of financial statements. Seriously. From the snapshot of the balance sheet to the story of the income statement, the expanded view of comprehensive income, the granular detail of EPS, and that whole breakdown of stockholders' equity, we've unpacked a ton. My head is swimming a bit, but definitely in a good way.
Yeah, it's a lot, but if we connect this to the bigger picture, it's clear that these reports are far more than just numbers on a page, right?
Absolutely.
They tell a company's past, its present performance, and they really do hint at its future prospects. Understanding these fundamental concepts, the language of business, really empowers you to truly analyze and interpret the financial health of any entity.
Gives you real insight.
Definitely. Insight into how well it's managing its resources, generating profits, handling risks like currency changes, and distributing value back to its owners. It's like learning the secret language of business.
So what stands out to you from today's deep dive after going through all that detail? Hopefully you, our listener, have gained a clearer picture of how companies communicate their performance and how many layers there are to peel back in their financial story. For me, I think that distinction between net income and comprehensive income and understanding where those OCI items live in AOCI, that was a real aha moment.
Yeah, that's a big one. And maybe this raises an important question for you, the listener, to ponder. Given all the detailed information available in these statements, all these rules and presentations we've discussed, how might a deeper understanding of these seemingly technical accounting principles actually help you make better personal investment decisions?
Right, how can you use this?
Or even just interpret the daily business news with greater insight, to see beyond the headlines and understand the true underlying performance and financial health of the companies you hear about every day.
It's about moving beyond just the surface level numbers.
Exactly. It's about understanding the story the numbers are telling.
Well, thank you for joining us on this fascinating deep dive. We hope it's given you the shortcut to being truly well informed.